So Janet Yellen is going to sell even more Treasury bonds. Guys, we said it time and time again that the borrowing isn't over, but I got it wrong. It's actually worse than we thought. Now, originally, I figured out that they were borrowing more debt on the front end, but the US Treasury is actually selling more longer dated bonds as well. They aren't just selling 1 month or 3 month T bills. Yellen is going up the food chain, selling up to 10-year treasuries. Now, this is a big problem because they are kicking the can down the road even more, and the interest payments are going to drag on longer than expected. What we are seeing is a last resort move to fill up the treasury account as a result of all those old debt maturing. Because of interest rates are going up and Congress keeps spending, they have to roll over the debt and borrow money at higher yields. And check this out, the treasury is offering $103 billion of treasuries to refund 84 billion of bonds maturing on 15 August 2023, and they are ramping up the issuance by additional $19 billion. So they are selling even more debt, and it goes all the way from 3-year notes to 30-year bonds, which is insane. And that means Yellen has to make interest payments for much longer at a higher interest rate. And this is the big blind spot that we forgot. It isn't just the new debt being borrowed, but the existing debt has been renewed at a higher yield. Now, if we look at the debt servicing cost, we are seeing a very disturbing trend. It is heading up and now at the highest level since 2009. The average interest rate on all US debt is fast approaching 3%. It's going to keep heading up unless the Fed suddenly drops rates. Now, normally this wouldn't matter, guys, but just look at the debt explosion. Over $1.2 trillion was borrowed in just 1 month after the debt ceiling suspension in June, and is definitely well above $32.7 trillion today. We are going to reach a point, guys, where this burden is absolutely unsustainable. There is a realistic limit to how much money you can borrow, and no country has a magic credit card that you can swipe forever. According to the Peterson Foundation, they predict that the net interest cost will account for 40% of federal revenues by 2053. So for every $10 the government brings in, $4, guys, will be used to pay interest on the debt. But I now think that estimate is conservative. The volcanic eruption will be much, much worse. At this current rate of borrowing and the snowball effect, I think we'll hit 40% by 2043 or even 2033. Now you might be wondering, why do we care? Because the more money Congress borrows today, the longer this inflation problem will last. And the longer we have high inflation, the longer the Federal Reserve has to keep interest rates high. But this nightmare isn't going to stop. Later in August, the Treasury will be selling $167 billion more in longer dated bonds. This is up by $11 billion from the last month. And it's a long-term mix that includes 16 billion of 20-year bonds locked in at over 4% interest rates. Imagine the increase in debt burden today that will continue for the next 20 years. So why is the US Treasury doing this? Well, it's very simple. Janet Yellen is either trying to save money or she believes that interest rates will continue to rise. She has to borrow more money, so in her mind, longer term bonds are the lesser of two evils. And if we look at the yield curve, we realize how badly the inversion is screwing the Treasury. The yield curve is extremely inverted, which means borrowing money at the short end of the curve is very expensive. If Yellen issues 1 to 6 months bonds, she'll have to pay over 5.5% yields to investors, and this is a lot of interest costs to pay. But if she runs towards the 10-year treasuries, she only has to issue debt at around 4% yield, maybe 4.2%, so she saves around 1.5%. And this is a penny wise pound foolish strategy because she's saving money today but condemning the future to bigger debt payments down the road. So we must understand the implications of such a move. If interest rates continue to rise for the next 5 or 10 years, then locking in a lower yield today kind of makes sense. However, if the economy crashes and Powell is forced to drop interest rates, then she is screwed. If the Federal Reserve starts cutting rates, we'll see the near-term bonds just crash to hell and the yields will start dropping fast. But because Yellen sold 5, 10, 20-year bonds, she has to keep dishing out those higher interest payments. And that is going to put an enormous debt burden on the American economy for years to come. So unless Yellen knows something that we don't, right? Maybe she's a genius. Maybe she realizes that rates are going to go higher for longer. Maybe she sat down with Powell and he told her that we aren't going to cut for a few years. Then it kind of makes sense. But either way, she might have doomed the US economy, and here's why. When Yellen starts to sell a ton of bonds, especially treasuries on the longer end, she forces a repricing of all other type of bonds. And this includes mortgage bonds, but more importantly, US corporate bonds, because US treasuries are considered risk-free, right? Corporate bonds have to be priced higher than government bonds. So if a 10-year treasury is yielding around 4%, a corporate bond of 10 years will have to be priced at around 5 or 6% minimum to get buyers. And the reason is simple. The treasury always has the Federal Reserve ready to bail them out with money printing, but companies don't. They don't own a printing press. And that's the simple truth. We all buy US treasuries because deep down we know the truth. The Fed will step in and print money if necessary. Looking at the corporate bond yields today, we can see things are starting to move up again. The yield on the corporate debt is almost 5.6%, while the yield for junk bonds triple C is around 13.7%. And the higher this goes, it will place an enormous burden on US companies. They can't borrow as much, which means growth will stall. And we all know what that means, guys, a recession. And I want us to look carefully at a tsunami of corporate debt that is starting to hit the economy because it's really terrifying here. In just the first 6 months of the year, US companies have issued an astounding $400 billion in corporate debt. Remember that this is debt priced at double or even triple the interest rates back a few years ago. See all that debt racked up from back in 2013 to 2021, those are going to get rolled over and repriced at higher yields. So the more long-term bonds that Yellen sells, the more she dumps into the economy, the higher the debt burden will be for all these companies. The trucking business Yellow, yes, the one with 30,000 layoffs, has gone bankrupt because of corporate debt. And this is tragic because now a ton of US truckers will be jobless, and finding another good paying trucking job in this economy will be tough. And at the heart of this is $1.3 billion in debt payments coming due in 2024. They can't afford the repayments, and rolling over the debt now at higher interest rates is just impossible. So many other companies are going to reach the end of the line too by issuing more treasury bonds. Yellen is going to make things worse. But let's talk about the retail investors, people like you and me. Because when more bonds they flood the system, it kind of changes the way we think, especially about risk and reward. Recall that the average return that S&P 500 delivers is between 7.5% to 10%. 10% is considered quite a good year. Now, if the risk-free rate from US treasuries keeps climbing up and up, you get an economy that will slow down more and more. That means a market crash gets more likely over time. And the risk-free rate of the world's biggest money market fund, the Vanguard Fund, is now yielding 5.24%. Do you know what that means? The average investor can now enjoy 70% of the stock market's average return without any downside at all. The US Treasury is just like the Lannisters. They always pay their debts because the Federal Reserve can just step in and print money. You'll get back your dollar amount, guys, but hey, purchasing power is a totally different issue, and investors will realize this sooner or later. If they can get a big upside with virtually zero risk, this will suck money away from the banks and other assets into US treasuries. Because the higher the debt servicing cost to companies, the higher chance of another yellow bankruptcy happening. And check out this insanity, guys. US corporate bankruptcies have surged in the first 7 months of 2023. 402 public and private companies filed for bankruptcies in 2023. We are heading dangerously close to the 2020 lockdowns. And that's why it's really amazing how resilient the stock market is holding up today. It's just defying reality, it's defying gravity. Now, just imagine if Congress didn't do deficit spending. This would crush the economy even further. And let's realize what's really happening here. The pressure is building up in the system, and the incentives are starting to build for investors to flee towards bonds. Money will flow away from risk assets towards the perceived safe haven of treasuries. Now, tracking the fund flows of money, it's obvious where cash is flowing to. In just a week, nearly 60 billion flowed into the money markets that buy US Treasury bonds. So there's this big vacuuming effect that's going to hit the market sooner or later. We are now in an epic struggle. The more Congress spends money, the longer they can keep this house of cards going. But at the same time, to keep spending up, Janet Yellen has to keep selling treasuries, and that keeps bond yields high. It's a deadly cycle that pushes some companies towards bankruptcies while keeping certain sectors afloat thanks to government spending. Hint, defense spending. But I want to talk about inflation for a bit now, because that is the big danger amidst all this end of the world talk. The longer the bond yields stay high, the more interest that's been built up in the system that's waiting to burst out. Now, I love to use the dam analogy because it kind of makes a ton of sense and is very easy to visualize. Every time the US Treasury borrows money, money gets trapped behind a dam in a lake, so to speak. And as the interest payments pile up, the pressure in the lake starts to build. Once the Federal Reserve starts to lower interest rates, all this built up energy will burst out and flood the economy. And this deluge of cash, coupled with the banks lending more, will cause a massive wave of inflation that will crash down on everyone and beat up asset prices. So, in the long term, the prices of everything, stocks, property, gold, will keep rising and rising because the interest paid on the debt will have to be borrowed again in the future. Do you see this vicious cycle? Either a bigger sucker lends more money to the US government, or the Federal Reserve steps in to monetize the debt and prints money, and sooner or later, guys, judgment day will come. And let's bring back the yield curve again because it reveals a lot about the future of bond yields. Now, right now, there's a horrible inversion where short term bonds are yielding more than longer dated ones. It's obvious that this state of affairs can't last forever. The yield curve will have to reinvert itself. So, either long term bonds suddenly rise well above 5.6%, so the curve becomes normal again, but that would mean we are living in a world where borrowing costs are insane. The 10-year yield will be 7 or even 8, 9%. This means mortgage rates will likely be 10% or higher to compensate for the added risk. At least to me, that probably won't happen. It'll break the entire economy and destroy everything as we know it. So the second scenario is more likely. This is where interest rates on the short end starts coming down dramatically, hitting 2 to 3% at the very least. But here's the big problem. In order for that to happen, the Fed will have to lower the benchmark rate, and the only way they'll do it fast is if the economy suddenly breaks, aka a recessionary crash. And that's why the odds of a recession are still quite high. If we manage to dodge a recession, it just means higher interest rates for longer. The debt burden will get bigger, and the payback will get larger, and the inflation problem will get worse. So the end game isn't looking good, guys. It's either a crash happens soon and we go through a ton of short-term pain, or we kick the can down the road and this inflation crisis repeats itself again. But this time, it won't be 8% or 9% at the peak. We could see double-digit inflation, even if we use the government numbers. That's why we must invest. We have to buy up assets, or at the very least, buy treasury bonds because things are looking really ugly 5 to 10 years down the road. The entire economy today is on life support, and even Wall Street knows this. Morgan Stanley warns of a hit to equity valuations if US fiscal spending is cut. The big banks, they know the truth. They know that the market is being propped up by cheap money and they don't want the music to stop. And we really don't know how this disaster will end. I'm personally preparing for both possibilities. We could have a horrific market crash because of higher bond yields, or an epic melt-up run in the stock market because government spending just won't stop. But what's guaranteed is an inflation crisis happening. I don't see Congress cutting down deficit spending anytime soon. America is committed to fighting Putin to the end. They are sending an additional $400 million to Ukraine, and that adds to the deficits. Plus, 2024 is an election year, so there's absolutely a tremendous incentive to keep the economy afloat. You can be sure that Biden doesn't want Trump to win, so this zombie economy will stay alive for a little while longer. So let me know what you think in the comments below. Is the US Treasury going too far? Will this borrowing end up in a crash or crazy melt up? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.